As a mutual fund investor, you would have come across the concept of portfolio overlap, where some of your mutual funds appear to share similar investments. Portfolio overlap arises when multiple mutual funds have investments in common. While a certain level of overlap is acceptable, excessive overlap is like repeatedly eating the same dish. In this video, we will dwell into portfolio overlap, its definition, causes, acceptable levels, and how to manage it effectively for your financial goals. Let's dive in. Welcome to holisticinvestment.in. What is portfolio overlap in mutual funds? Portfolio overlap in mutual funds refers to a scenario where multiple funds hold similar or identical securities in their portfolio. Imagine you have invested in different mutual funds. You discover that they both own the same stocks or similar investments. This situation creates overlap, which can occur when fund managers adopt similar strategies, track the same market index, or invest in well-known companies. To illustrate, consider two mutual funds, ICICI Prudential Blue Chip and SBI Blue Chip, both belonging to the blue chip category. Due to their category focus, they might share some investments in their portfolio, resulting in overlap. For example, if both the funds have invested in ICICI Bank stock, any price change in ICICI Bank would impact the performance of both funds, affecting your investment returns. This overlap is more common in funds that focus on smaller universe of well-established companies like those in the blue chip category. Blue chip companies are typically the top 100 companies ranked by market capitalization. Next, understanding why portfolio overlap occurs. The question of why portfolio overlap occurs is crucial for investors aiming to minimize such occurrence in their investment portfolio. Here are some common reasons for portfolio overlap. Investment style or strategy. When fund managers or fund houses share similar investment philosophies or strategies, such as focusing on rapidly growing sectors like AI and investing heavily in technology stocks, it leads to overlap in their portfolios. This happens because their investment style align, resulting in similar holdings. Limited universe of investments. Certain mutual funds have predefined restrictions on the types of securities they can invest in, like size, sector, or geographical location. The limited universe creates overlap when multiple funds share similar investment constraints, such as thematic funds focusing on specific sectors like technology. Next, benchmark tracking. Many mutual funds aim to outperform specific market benchmarks. To achieve this, they include securities that mirror those in benchmark index, causing overlap in holding as they strive to replicate the benchmark performance. Next, concentration in popular stocks. Mutual fund managers often respond to market trends or economic conditions by investing in popular stocks. This shared information landscape can lead to overlap when multiple managers independently choose to invest heavily in leading companies, especially in sectors experiencing growth due to significant announcements or trends. These factors contribute to portfolio overlap, impacting diversification and potentially affecting investment performance. Understanding these reasons can help investors make informed decisions to manage and mitigate portfolio overlap in their investment strategies. Next, understanding the impact of portfolio overlap on your investment portfolio. Portfolio overlap can have several adverse effects on your investment. Let's dwell into how overlapping holdings across mutual funds can affect your investment profile. First, reduced diversification. Portfolio overlap reduces diversification benefits by concentrating holdings in similar securities, increasing risk. This hampers the portfolio's ability to spread risk across different assets. Next, increased concentration risk. Overlap holding leads to concentration risk, exposing a significant portion of the portfolio to specific securities or sectors. This heightened exposure amplifies risk, especially if those holdings perform poorly. Next, higher cost. Portfolio overlap results in increased cost due to management fees and expense across multiple funds. These higher costs can diminish net returns over time, posing challenges surpassing inflation-adjusted returns. Next, limited upside potential. Overlap restricts potential gains and may cause missed opportunities from sector rotations and emerging trends. This limits the portfolio's upside potential and can hinder achieving significant gains. Next, lack of flexibility. Investing in funds with overlap holding reduces flexibility to adjust to market changes or optimize asset allocation. This lack of flexibility can hinder achieving specific investment goals and adapting to evolving market conditions effectively. Now that we understand understand the potential drawbacks of portfolio overlap, let's explore how you identify overlaps in your investment portfolio. Step 1. Review fund holdings. Research and gather information about each mutual fund's holdings from their prospectus, reports, or the fund company's website, that is AMC's website. Step 2. Create a consolidated list. Compile a list of all securities you are invested in, including their name, ticker symbol if available, and the percentage allocated in each fund. Step 3. Identify common holdings. Compare lists to find securities appearing in multiple funds, indicating overlap in your portfolio. Step 4. Calculate overlap percentage. Add up the percentage of common holding across funds to determine the overlap percentage for each. For instance, if Fund A has 7% of stock X and Fund B has 3%, then the overlap percentage for stock X is 10%. Step 5. Consider rebalancing. If significant overlap is found, rebalance by reducing exposure to overlapping holdings or reallocating funds for better diversification. Utilize tools and resources. Take advantage of online financial tools and resources to simplify the process. Many websites offer portfolio analysis tools that can help you identify overlap and evaluate the diversification of your portfolio more efficiently. For example, you can use tools like Fundo or rely on search engines like Google to assist in calculating overlap percentage and optimizing your investment strategy. Next, determining an acceptable level of mutual fund portfolio overlap. Aim for less than 33% overlap in mutual funds to ensure diversification. Imagine two chefs are creating different dishes, say pasta and pizza. They might share some ingredients like tomato sauce in common, but they maintain distinct flavors. Similarly, mutual funds with minimal overlap retain unique compositions, enhancing diversification. Now let's explore ways to address portfolio overlap. Diversify across asset classes. Ensure your portfolio includes a mix of different asset classes like stocks, bonds, real estate, or commodities. This diversification helps reduce overlap within each asset class, enhancing overall portfolio diversification. Diversify across fund categories. SEBI's guidelines for fund categories help investors diversify effectively. Investing in funds across different categories like large cap, mid cap, small cap can minimize overlap and align with your specific investment objectives. Next, diversify across asset management companies. Avoid excessive overlap by diversifying across AMCs. Different AMCs may have distinct investment styles and biases, leading to varying portfolio composition. Investing across multiple AMCs can reduce overlap and enhance diversification. Periodically review and rebalance. Regularly review your portfolio for overlap and rebalance as needed. Conduct reviews every 6 months to align with your investment strategy, adapt to market changes, and prevent unexpected increase in overlap. Seek professional guidance. Consulting with a financial advisor can provide personalized recommendation based on your investment goals and risk tolerance. Professional advice can help optimize your portfolio, manage overlap, and align with your long-term financial objectives. By following these steps, you can effectively manage portfolio overlap, maintain diversification, and optimize your investment strategy. We would like to conclude that investing comes with significant responsibilities, including managing diversification and avoiding excessive portfolio overlap. While some level of overlap is acceptable, it becomes destructive when it reaches high levels. High portfolio overlap in mutual funds can diminish the risk-return balance of your portfolio, increase cost, and undermine the benefits of diversification. Therefore, as an investor, it is crucial to remain mindful overlap when constructing your investment portfolio. To address this, consider consolidating holdings and diversifying across various asset classes, investment styles, and geographic regions. This strategy helps mitigate risk effectively and enhances the overall performance and resilience of your investment portfolio. Wishing you success in your investment journey. A detailed blog post on this topic is available in our website, and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming Enlightening Investment Webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.